Welcome back to the Damp Spring Roundtable. Today is Sunday, April 26th. I'm Ben. Joining me today is Andy Constan, Jimmy Jude, and Nick Lentz. We're now 4 episodes in, and this might be the most interesting backdrop we've had to work with. We've got a war in the Middle East that's been going for months, oil sitting right at $100 a barrel, and the stock market at all-time highs. And the new former hawkish Fed chair is showing dovish. None of this really fits together. So let's get into it. Going back to last episode for a second, because some pretty specific calls were made, I want to know how everything played out. Jimmy, you called for a simultaneous flush across basically everything. S&P to 6,300, NASDAQ to 23, and gold to 42. You said that it was going to happen all at once. We're now sitting at all-time highs in equities, with oil right at the $100 line. So before we get into other things, I want to hear how you guys think things actually went. So,
it was pretty obvious that the market was due to flush, right? Everyone was in a situation where there was too many early dip buyers, and we needed that flush out. We needed that final push lower. And like you said, we called it, but we need to focus more on the future and not just worry about like buying the dip there. But it's like once we got that flush, then it's like you start thinking about earnings, you start thinking about forward earnings, you start thinking about, is the economy going to be okay? Because now we're talking about entering a real bear market, and is there a reason to enter a bear market? And that time, at that point where the economic data is, there was just no reason to assume that this was the end of the cycle. So, it made sense to buy the dip there. Obviously now we're very extended. I bought the dip with both hands. I bought pretty much everything I could buy in my personal accounts and stuff. And I've had already a stellar year, but I've scaled out of most things to much more manageable levels. Even in my long-term accounts, I have at least probably 30-40% cash. I have to check, but it's a lot. I don't usually get to that kind of level. So, did things change? Yeah, of course things changed. In general, war is not a reason to go into a bear market. It's just not. You need more. And the war is not good, but neither is Russia and Ukraine. Neither is all kinds of things. So you have to focus on the future. Time to scale out of your risk if you haven't already. I don't know how you couldn't. But yeah, that's I think that's where we are
now. Sorry. Go ahead, Andy.
No, Jimmy, you go.
We saw the moves that they were kind of technical at the end. When you get these, you're already in a big downtrend, and then you get the washouts, and they go into technical areas that we were looking for. And we got that disconnect in the yield curve where it started to get more worried about, markets caving than it was about inflation. So we bottoms started forming. All that made sense, and that was what we were looking for and what we were calling for. What has happened since, I couldn't say that I saw coming. The bounce has been immense. I did have a feeling that, and because I've seen them do it before, I thought that they would try to juice the market over the 200-day. When we approached it, I've seen them juice the market, at key technical spots like that before. It worked again. But one of the things about our calls and why we were confident going into them too, we were somewhat confident that Trump would cave a little bit, not, burn the house down in this situation and be cagey around the lows. And he was, and this administration was cagey around the lows. I think a lot of that is Bessent, to tell you the truth, pulling the strings at the correct times. And, obviously, I don't think Trump has the capacity to, but he knows how to, once you tell, P.T. Barnum, now's the time. He knows how to take the reins at that point. And we saw how powerful that could be. I think that in a lot of places, though, we came in and we were thinking, okay, this market is stretched. We gapped up huge over the 200-day. We really ran, but we didn't think we were going to make new all-time highs. So we did lean in short around the swings of the previous all-time highs because we thought the market was going to kind of fizzle there. And that turned into be, a very squeezy situation in a lot of individual stocks in the indexes, ripping through all-time highs. But then in a lot, areas like tech and SMH stocks, things like that, they went absolutely parabolic, ballistic, which I don't know if those are moves or those squeezes. I think they were moves, but I think we're seeing it right now. I think we're seeing squeezes at the end. I don't think it's healthy moving forward. I've seen some really horrible takes about, markets that rip up like this, you can't fade them, or you can't, it's like you can't join them either. Okay. Like show me any chart that makes parabolic moves like this and they outrun their wave structure. And what I mean, they outrun their wave structure is there's no longer Fibonacci math at their, behind them. They're off the charts. And those, the best thing a market like that can do is go into a very long-term complex consolidation at those levels and digest everything that it just did. But that's low probability that markets do that after, when you see a move like the SOX or SMH, those markets usually, those moves lead to collapses, and we have no support underneath the market, really. The biggest support we have is this last week's consolidation. We really did kind of consolidate in the larger indexes to give us some re-energize the markets and stuff. And if we do get above them, they could, be support going forward. But there's nothing really structural or diesel underneath this market for a bump in the road, and that's why we're still bearish technically. We still think, these markets are begging for a retrace. I think the healthiest retrace that could happen is to watch the S&Ps go back still that massive gap they had. I mean, what was that predicated on? Peace talks and the end of the war, and what's the progress right now? Like why shouldn't we go back and test that? And having earnings this week could lead to one of those moments. Those massive buy the rumor, sell the news, and we see the market top out and it's not, and that's not a bearish statement on equities overall. It's just a bearish technical call on where these markets, they've come too far too fast. You can't, they say trees don't grow to the sky. And it's true in markets. It's, these are provable facts. So that's why at this point, it's best to either be patient and wait for a decent entries again, but definitely don't join the party up here. I think one thing I would like to say about fixed income that I thought was kind of interesting last week, I started to get nervous again. I thought the curve was making very bullish type patterns. And then, crude was really buoyant going through the week. We didn't blast off, but we just incrementally made higher highs, higher lows in crude all week. And it started to bleed into fixed income. The front of the curve started to get weak again, started to move down. The curve across from fronts to backs moved down to those April lows, and it starts getting into some technically uncomfortable areas. We start cracking April lows, the charts start getting broken again, and we reopen the charts down to the March lows. And that's when, you saw that Piro, dropped the case again. That could have been one of those moments again where Bassett, popped into the Oval Office and said, "Hey, listen, this is a time where, we were always going to drop this case anyways. Let's do it now. This is a kind of the rubber's meeting the road here." And that was a major sea change in the curve. The curve really, got strong across the board. It held those April lows, so technically it's still sound. We saw a ride, crude. It's not like crude dumped on Friday. Crude actually finished well off its lows and was rallying into the close and finished, last Friday, D's crude finished around 73. We finished around 77.50 this Friday. It's trending higher, but the curve chose to ignore that. And so we might be seeing like a major sea change where the curve is like, okay, this guy's getting in. It's going to be a different cast of characters, and they're seeing past the Powell, administration. And that would be super constructive going forward, for sure, for everything. I don't know if we're going to see rates break out at this point, but it's an interesting divergence to keep an eye on moving forward this month, because we could see some wind now at the curve, and anyone at this point, if you ask them about rates, no one says, "Oh yeah, I expect rates to be lower" at this point. Everyone's too chicken shit to say that. So it would be interesting.
So, I want to look. We're going to talk about this coming week, but last episode we talked about the week ahead as being a major opportunity, and we were focused on a week ahead. In this section, I think we want to focus on longer term. And so when I look at that, I say, what's new? And I think since last time we spoke, obviously the big change is that the two sides are talking. Now, that doesn't mean there's a legitimate ceasefire. I mean, part of the reason why we had the washout was concern about an ongoing war. The rally certainly was kicked off by a ceasefire, along with all the technicals that we had mentioned. And so here we are, we have a ceasefire. And I think markets are okay with a ceasefire, but that to me still misses the big picture, which is, again, it's not going to play out in the next week's market action, but the big picture is that there is a period of time, even in the most optimistic cases for the end of the war, resolution, some deal, which could be announced tonight or tomorrow or whatever. It doesn't seem like there's a deal pending, but I think we have to expect what could happen in the event of the most optimistic outcome for the world. And that would likely be a full reopening of the strait, and a meaningful decline in oil prices. But the question is how much damage has been done, and will that damage impact the overall economy? And so I think the jury's still out on that. My expectation with oil in the high 70s for December is that there's significant headwinds for consumption, domestic consumption broadly, not due to the very high oil prices for the balance of the year. So let's just put that as the best case. Ongoing, significant headwind toward personal consumption due to higher oil prices. So I think that's about as good as we're going to get. We could get substantially worse depending on how long the war lasts. Okay, so that's one thing. The other thing is it's definitely the case that earnings for chip makers have come in very strong. Now, was that expected? Well, clearly not. Stocks like Intel are up over 100% in a year. In this, not in a year, in this year. And other stocks are, the semiconductor index is up 25% in less than a month. So there's definitely something going on with picks and shovels and expectations. So let's put that aside and say that's happening, no doubt about it, and it's supporting overall equity prices. We're in the midst of a couple of moving parts on the fiscal side. One moving part is the reconciliation. And the reconciliation gives the administration the opportunity to, the primary thing in what they call the skinny bill is to fund what they've already promised to fund, the DHS, which is the only one of the 11 departments that is not currently funded. And that's because of the Democrats blocking it for the ICE payments, et cetera. So it's political, and the reconciliation can handle it and likely would succeed. And then there's all the Christmas ornaments that they might try to hang on the reconciliation. And those are the ones that you have to be conscious of. And so are they going to significantly cut taxes like they did in the OBBB, which favors consumption, meaning they cut taxes on tips, they cut taxes on Social Security benefits, they cut taxes on interest payments for new car loans, a number of tax cuts with spending only affecting Medicaid and food stamps. Will they be able to attach a bunch of things that'll be deficit increasing? Because if they are able to do that, I don't think they are, but if they are able to do that, deficits will increase and that'll be stimulative and perhaps easily offset the drop in consumption of due to oil. So that's another thing that's ongoing, and we're going to get data over that in the next month or two. Then we add on top of that the Fed policy, and we'll come back to that maybe when we talk about Warsh. There are things to watch, and the Treasury policy, Bessent could manipulate the issuance. We'll come back to that later. So all of those things represent big things to me. But none of those have actually changed in the last few weeks that take us from 63.50 up to 71.50 on the S&P, or explain the rally in tech stocks. So early on the April 15th, I went to max short for DS Alpha. And I spent a few percentage of, I had already had some puts, but I bought a bunch more puts with the S&P at 69.60, 69.70-ish. I was too early. What I think happened during our last call, a range of 6,600 to 7,000, which is about right given the economic conditions, overshot to the downside and has now overshot to the upside. And so that's my basic picture of where we are. And I feel fairly strongly that by June we will see, those levels that Jimmy's talking about, mid 6,600-ish. And that'll be a great opportunity to go flat or possibly even go long equities. But we'll have to see all these various outcomes. So layer on top of that something that in each of these calls and in most of my writings I continue to be interested about is, where is the growth coming from? The growth has been coming from consumption by most of the economy is consumption and investment. And investment has been limited. Housing isn't getting investment. Non-tech factories aren't getting invested in. It's all going into AI CapEx. And for that reason, obviously, the semiconductors have been the primary beneficiary of that. But that's where the CapEx is coming from, and it's huge. And the war is going to be expensive and require more global sovereign debt to be issued, sovereign global assets to be sold to pay for the loss of oil revenue. All of these things and yet savers are not able to save more because wages aren't improving quickly. And so it must require a levering up of the economy to get all these promises paid for. And to do that, I would think one would want lower asset prices, higher yields on bonds, lower prices on stocks, et cetera. And so I think of that, those for all of the growth that's priced in. And by the way, S&P forward-looking growth after the recent guidance changes by those who have reported is up to 23% for the next 12 months, 23% earnings growth. To get that earnings growth, you're going to have to do all of the CapEx, at least, all of the government spending, and all of it will have to get purchased by asset holders. And to me, that just represents a very heavy overhang on stocks, bonds, all assets. So that's where that's my framing of what I'm paying attention to. And I'm short that, I'm short stocks, max size, and I'm short oil as a hedge, because I do believe if oil were to collapse, December oil were to collapse to the mid 60s, everything would be okay with the economy. Like, that would take all the pressure off the economy. On the other hand, if oil's here or higher, I don't see how we haven't seen a significant slowdown without all of those other levers that I just called, which are the 6 big things I'm focused on, all of those other levers breaking bullish.
That's the big question. Where's Crude going to be in 30 days? I think that's what it all boils down to. Because Nick's right, like, war isn't necessarily bad,
No.
but $150 oil is, and that's the ramifications of this war. This isn't just like war with some country that, this is war with, and any bump in the road in this war, and oil goes up 20, bucks from here. And this is like pretty much the Mendoza line here at 100. Now, at least markets are going to get nervous over 100. It may not start affecting the consumer until 130 or 150, who knows, but at least it'll look bad. The optics will be bad. It'll be ugly filling your car up, and that won't help the economy.
What do you think about all the folks that are talking about fertilizer and, the price action in corn, sugar, food commodities generally? The people are talking about, which is, I guess, bullish for semis, capacity constraints due to helium prices, all of the unexpected follow-through points around energy prices. To me, those seem like, so one thing about war, it's great if you're not the country involved and you sell stuff to all the countries that are involved. We're obviously involved, but it's arguably the case for U.S. industry. It's a pretty good thing to have a war. What do you guys think about the second order effects on, things that we consume every single day?
Yeah, well, one, obviously, I'm not a helium expert, so I can't really comment on the actual supply chains of helium. But I have 2 things to go on that. The first one is, I think when it comes to people guessing about like what's going to happen in a war, there's always people that want to reach for that thing that nobody's thinking about. Like, oh, you predicted oil, but did you talk about helium, or did you do this? And one of the things I think people severely underestimate is the human ability to adapt. And in COVID, everything got shut down. So supply chains had to be more resilient. Companies had to be more resilient. And it's not like these people just sit around and just think like the strait couldn't be closed at some point. Like, people do think about, like, if your only source of water comes from down the street, like, you don't forget about it. You don't think like, hey, if this street gets cut down, how am I going to get water? It just doesn't surprise you one day. You're just like, oh shit, now I don't have any water ever again. Like, no, they have built-in things. That said, obviously no one expected the strait to be closed for this long. And it sort of has been an awakening, I think, to oil bulls about just how much supply is available, but also just to the you can't decide the whole future in a month, right? Like you can't map it all out. The world is just way too complex. There's just too much going on to say like, oh, there's not going to be any helium or corn's going to go to $1 million. And they did the same thing when we went to Ukraine. Like I had never heard this because I never follow Ukraine, but it was the breadbasket of the world. It had all these other things. Like the wheat prices shot to the moon. Like, but none of that happened. Like literally none of it happened. And Ukraine is a nightmare. I unfortunately have to follow some Telegram channels that for up to date news on wars and stuff. And every day there's some horrid thing happening in Ukraine. Someone getting blown up, some drone going, missiles going everywhere, energy, and nobody cares. And so yeah, there's definitely going to be ramifications. There's going to be things that happen, but people will adapt and things will get more expensive. But it's not going to get like helium could double for a while, right? But like they're going to get the chips. They're going to get it. If you need the chips, you're going to get it. You're just going to have to pay more money for it. If you need the oil, you're going to get it. You're just going to have to pay more money for it. And so is that going to increase inflation for the average person? I don't think so. I don't think it's good. I don't think there's anything good about it. I do think you're going to see an effect in corn prices, sugar prices. You're going to see a momentary spike. It's just, do you believe it's going to continue for as long as you do? And then you have to put yourself in the camp. You have to put yourself in the camp of, well, who's winning the war? What's the definition of what's going to open the strait? All that stuff, which, to me, I have my own opinions, but I would focus more on what you said, Andy, the broader picture, the big economic drivers, the things that are actually affecting people's pocketbook. And when we start thinking about like to these lesser degrees, I think, yeah, it's going to be like when cocoa prices went crazy, or
Right,
when
but
orange juice prices went crazy.
So the question is, so I think what you're saying is that we had a big overreaction to the war that has persisted, at least in the oil market. Like, we're still pretty damn near the highs.
Yep.
But hasn't persisted in the bond market, in the stock market, in the gold market, in the U.S. dollar market, and generally that's about right. That shouldn't persist. But we're also, a few hundred points higher than the pre-war sort of top.
Yeah, I guess when I'm a systematic guy. You guys trade with me. I do breadth models. I do all kinds of things. The only reason I believe to look past the war is because I've looked at the data, and the data says look past it. So that's why I look past it.
I'm agreeing with you.
No, I'm not arguing. I'm just explaining this. So when I bought the dip, it was because my system said buy the dip. And did I expect us to rally to 7,200? Of course not. But my statistics show me that it's totally possible that these things can happen. And so now that we're up here, all I'm doing is I'm adjusting the book. I'm thinking about these long case scenarios, but I'm not assuming that things are going to get that bad. I'm not assuming that a corn price rise in the short term is going to change things, because eventually it could. But we'll start to see that in credit. We'll start to see that in balance sheets. We'll start to see that before. Like, it's not just going to come out of nowhere. And so I think
yeah, 100%. I mean, the idea that people don't already incorporate all this information into their outlook for every asset would be, I think you're right, naive to think that would be the case. So here we are. We've got a couple of interesting things happening this week. You want to kick us off, Ben?
We have the potential confirmation of Warsh for the Fed chair. He was known to be hawkish, but is showing a dovish face. And my question is what would a confirmation of Warsh look like immediately, and then after he's able to put his policies in place?
Right. Let me give that one a shot. I'll be writing a DSR for clients. I'll be writing a DSR this weekend that discusses that. the update, the most current news is that Warsh had his confirmation hearing. It was like every other confirmation hearing. No news. Let's get the job done, and highly political. The only thing that mattered was that Senator Tillis said, who is a Republican, said he won't vote for Warsh until the D.C. Circuit, D.C. Attorney General Pirro drops the investigation into the building scandal, and he's the vote. You know, if he votes against it, it fails because all the Democrats are going to vote against and all the Republicans are going to go for. So he stood up, and Pirro dropped the case. Now, does that mean it's permanently dropped? Who knows? It's enough that Tillis this morning said, Warsh will get my vote. So we're going to have a confirmed, so that's the news. We're going to have a confirmed new Fed chair. The second order thing is, okay, we're going to have a confirmed new Fed chair. What's going to happen to the governor's seat when the current chair leaves his post as chair and becomes governor? And so we haven't heard from Powell. Let me tell you something. All the reporters' questions for this week's FOMC meeting will start. The first question will be, are you staying? And I don't know the answer. I don't think he will, but he has to trust Trump to not get his guy in place and then restart the investigation. And I'm not sure he's a trusting guy in that case. He also has the Supreme Court, which is yet to rule on Governor Cook's mortgage problem and her firing. So he may stick around. But we have to come down to what it will mean for short-term interest rates. And Warsh is very clear. He thinks short-term interest rates can come down, and because of transitory inflation, falling oil prices, generally AI productivity gains, and he's also mentioned that he also wants to bring short-term interest rates down and also reduce the balance sheet. Now that is a tightening, so short-term interest rates down, balance sheet smaller, might actually be pretty neutral to the economy. But that's the guy going in. And so when I total up the votes for June and include Warsh, Williams, Waller, Bowman, and let's assume Powell resigns, and it could be any stooge, but let's assume it's Myron as the stooge. Myron shows up. That's 5 out of 7 votes they need. So I think the path to Warsh cutting interest rates, if that is in fact his desire, is pretty open. What do you guys think?
I think that, one, when people get in the seat there, they can be different, right? I mean, Trump is the one who picked Powell. So, obviously they don't get along. And obviously, and I think it's also a little, I think it's too much of a reach to say that he was a hawk, you know, he just had some views that a lot of people at the time had on the view that if you make the balance sheet huge, we're going to have inflation. It turned out not to be right, but most people thought that. And so it's like, what is he going to do? He's going to come in and he's going to be a Fed guy. You know what I mean? He's not going to be, I don't think he's going to be a revolutionary. I don't think he's going to come in and just try to flip the whole system. I think he's going to come in. I think he genuinely probably believes what he says he does. I don't think he's just there to do Trump's work or whatever, just like I didn't think Waller was there to do Trump's work. I think he's just going to do that. And I think the more interesting thing will be, like you said, with the balance sheet, because that will, if he actually does attack the balance sheet, that will affect stock prices more than people think. And I think that people we have the K-shaped economy, and obviously I'm not super rich or anything, but if you give me $1 million today, I'm not spending it. I don't need anything. I'm going to put it in assets. You know what I mean? And so like if they start restricting that balance sheet, we start like kind of taking that down, that's going to hit asset prices to some degree. And so that is something you need to watch. As far as the near term, we're along the SOFR M7s. You know, thankfully I bought them back the morning. I closed them the day before and bought them back in the morning right before this got announced, so I got lucky there. But yeah, like I think they're going to go on the cuttings on back to cuts. I think they're going to get at least one or two before the middle of next year. And then I think they're going to see what happens. You know what I mean? I don't think it's going to be like they're going to cut every meeting. I don't think they're going to cut by 50. I don't think they're going to do anything. I think they're just going to start a cutting thing. And I personally, you know, just me, I think it's not a terrible idea because there are signs that interest rates are too high, and and one cut isn't going to end the whole world. And so I think it's a good idea to do it. I think they're going to do it. And I think when we look at this war, when we talk about oil, when we talk about inflation, when we talk about tariffs, we have literally had like the worst possible outcome for inflation, like tariffs, oil supply chains, things like we've had everything stack up, and it's just holding. So there obviously are some disinflationary forces out there, and so I think it's a good idea. Let's see how it goes. But I think like projecting more than the next meeting or two, and I may not the next meeting, but the next series of movements, I think will be to the downside. I think it will be a cut, but I wouldn't think that like we're going into a whole new like Fed regime of like kind of a controlled Fed. I don't think that's the case, and I think Warsh will be just a typical Fed guy.
I think at least for the next 2 years while Trump is in office, I think he's going to play ball. I think he's going to lower interest rates and dangle the carrot of the balance sheet on why he's doing it, and that this is a better idea. Like higher interest rates are hurting low-income people. They're hurting people with credit card debt. You know, play that card, but he's going to use the balance sheet with a feathery touch. Like he'll only, you know, he's going to juice that when things are good and when stocks and assets are high, and pull back, and you know, because that's a lot harder to understand for the common investor than just interest rates, you know. I mean, I think it's interesting too that this week everyone is so you know interested about you know the Fed, you know, and independence, you know, but no one had anything to say back when it was Yellen and Brainerd and Powell in cahoots with each other. The only one on the internet was Andy saying like, Jesus Christ, they're muting, you know, they're with issuance, you know, what they're doing in interest rates, and that's only going to prolong this, you know, inflation picture. No one had a problem back then when they were all in bed together, but now all of a sudden, you know, I mean, I think the concept of Powell staying on to, you know, keep the, you know, I think that's such bullshit. And if he does, that's a really strange environment. And I don't know who his masters are to keep him there, but that would be weird. I think, you know, so I think we are heading towards an easy Fed. That's going to be, you know, it's going to be a wind at the back of asset prices.
Gosh, I look at SOFR across the curve out to M8, which is, you know, like 8 contracts back.
That's the most mispriced thing on the planet.
What the hell?
I think.
We've got 20 basis points of cuts. Now, there are a lot of guys out there, gold bugs, inflationistas, higher for longer types, Fed's making a mistake, screaming at that. And so what are we missing? Is inflation really not a problem? You know, that's the big question. Or for that matter, so it's either one of two things. Either inflation is not a problem, and these guys are just wrong that inflation is a problem, or inflation is a problem and the Fed's not going to address it. And I think it's important to at least consider those two possibilities, because if it's not a problem, SOFR's cheap as hell. If it's the second thing, SOFR's still pretty cheap.
It's still pretty good.
You have to say, geez, are they really going to hike? Like, could you see what circumstance are they? The only thing I can play through, and again, this is not what I like to do. Like, I don't like to look out 6 months. I hate it. Like, 6 months is too far from me. But 6 months is the election. If they lose the election, does the Fed then say, fuck it, we're hiking?
Yeah, I get what you're saying. Like they're gonna just, because they don't have the backdrop. But, I really don't think that there's this like battle between the Fed and the government. Like I think Trump is both a crazy person and a genius, and he just uses Twitter, uses the bully pulpit, and he tries his best to push people around. I mean, I'm
not even trying to talk about that. I'm just talking about, here's the pricing of SOFR. It says pause.
Yeah.
The Fed is always dovish. I don't give a fuck who's the president. I don't give a fuck who's the chair. Go back to fucking Volcker when you saw the last actual hawk. Even the clowns that have hiked rates, Greenspan hiked rates in 95, late 94, early in 94 through to 95, hiked rates when there was just, and immediately reversed. The second the bond market said no mas. Cut in 98 in the middle of the tech bubble multiple times to save long-term capital, for Christ's sake. Cut in 07. Like, I mean, 07, oh my God. 2020, oh my God. And then 2023, a couple of banks had some problems and they flooded. They're all the fucking same. So you have to talk about whether the Fed is, whether Trump is the guy that's going to cause. These guys cut.
Yeah, which was kind of what I was saying is that I don't think a Democrat shift would change that bias. I don't think they would come in and be like, oh, now we don't have to deal with Trump, so we're gonna get super hawkish. And I'm just saying, like, what is gonna cause these guys to hike?
I think the pricing. I think the pricing right now that has led us to really, like, try to get long it 4 fucking times, be spun out, keep going after it, still like loving the trade, scratching our heads. I think it's got a little bit of TDS in it. This like, oh, they might have to hike, and it's like, are you fucking crazy? But I also think that was tied to the lawsuits and the criminal, I guess, charges that were looming. I think Friday alleviated that.
You think
I think with that off the table, and now he can get approved and we can move forward and we can move into a new regime. I think that alleviates all the stupid pricing, because now you're like, okay, now with this guy in the seat, guess what, folks? That was always the scariest trade on the planet for me, to be short SOFR. Are you fucking crazy? Anything happens, 9/11, you know what I mean? You're evaporated immediately, okay? Especially when they're like pricing out a flat curve, moving out. No way. And on top of it, any type of inflation spikes that have anything to do with Iran or energy will be explained away going forward the way we've seen it in the past. Transitory, whatever, I'll address this in the balance sheet. We'll get we're going to get a lot of massaging, but the massaging will be back to like what you said, the Fed cuts, and we should.
So that means long twos, short bonds, long gold, short the dollar, long stocks.
Yeah. But not long stocks here. We need a dip. I wouldn't buy this shit with someone else's money. Fuck that.
Oh, what do you think SOFR does on Monday? I mean,
I think it continue. I mean, I think it can. There's a lot of room to the upside.
I think there is a lot of room to the upside.
A ton of room.
Well, look, Nick and you in DSMMA have M7. I missed M7 equivalent by buying 2-year notes. I missed them, but I still have M6, which
It's
could
still
get,
cheap.
Still
Stupid cheap. I mean, shouldn't we be pricing in like a Fed that not only wants to cut at least a quarter, maybe 50 basis points in the next 11 meetings, but you might actually price in another 25 basis points because this Fed's going to get super fucking aggressive if anything bad happens,
That's for sure.
For sure. So, you know what I mean? That's another 25 basis points. So these fucking things are 50 basis points too cheap.
Well, people get in my head on inflation. You just get every day people who are bearish bonds thinking the Fed's making a mistake constantly in my head. You just think that's just bullshit.
Right.
I don't think it's bullshit. I think people want to see like a different dynamic. I think we've been in like a disinflationary thing for such a long time. You get the first whiff of inflation, and now people want to be with the turn. They want to go to the next thing. They want to be in that trade. And the idea is, like I said before, you couldn't write a better book for these people for what happened.
Right.
You have Trump come in and just put tariffs on everything, ping ones, anything you can think of, right? So that everyone has tariffs. Then you have wars. You have multiple wars. You have oil spikes. You have everything in the whole world, and people are like, well, PCE's like 2.7% for a while. Like, who cares? Like, it's been, like, you got everything. It should be 10, with everything that you got, and it's not there. So there, obviously, you have to just stop and look. You have to say, we had this much time. We've been stalled. We've had every possible bad thing come up. We've had taxes put on the whole world. We've had inflation spikes in oil, and yet it's not higher. So that's kind of the thing when it comes to like you just got to look at the price and just assume that the whole world just doesn't get it. And then, like we said, with the SOFR, it's clear to me that SOFR doesn't trade like the euro dollars. There obviously is like a bigger tilt towards this economic the inflation fear in it. And I think that's just because people got smashed being long 0% bonds, and they're hurt, like they're
So
worried about
let's look out past SOFR to the long end and gold and the dollar. We've made our case for stocks. Sure, easing's going to be good for stocks, but we're not chasing. And I'm short on not covering. I don't have a position in gold or bonds for alpha. What do we think there?
Well, we had a gold position, and I closed it just because we made a decent amount of money on it. So that's why we closed. That's why we closed it.
I of course took Jimmy's 4,200 bid and didn't put it in during the pajama session. And it printed 50 or something, like
4,100.
Yeah.
4,100,
and I missed it, and then didn't fucking chase the thing. So nice trade by you guys, shitty trade by me. Well, nonetheless, here we are. Oil is the thing where if the Fed is easier than they should be, you want to own, gold. You want to own gold if they're easier than they should be. But I don't think that's what we're saying.
I mean, I think it's all such a different dynamic. Gold made such a big move that I don't think that 5,000 is a lot of money for gold. So you know what I mean? Like it's moved a lot. So I think that kind of covers that base. As far as
4,700, it's sort of nothing.
I say 45 to 47 is a decent place to add to like a long-term allocation. Like you add 1% to your whole portfolio or something.
Yeah.
I think under 4,000, you buy it as an alpha. I think over 5,000, you start to think like, no, this isn't value anymore.
Yeah.
Like it already
okay,
ran.
fine. That's where I'm at. Jimmy, you have any different view?
Yeah, I would. I think the last time we talked, it was similar. I'm a buyer at 4,600, and I'm a seller at 5,000 right now. I think it's rangy. It hasn't broken the negative sequence since the highs, so it's still in a. We had a good bounce and retrace off those lows in late March, but it hasn't done anything long term technically to say like, oh Jesus, it's on again to the highs. Although in this environment, that kind of makes 4,600 an attractive area to at least take a shot at getting long and seeing if this, if it does start responding to an easier Fed, and before we know it, does start making some technical moves where it breaks some levels. So
Okay, that's
I
good
would
enough.
I would buy that dip.
Ben, you had a question on QRA before we jump into the long end.
Yeah, I guess my main question is as a person who's not as deep into the markets as you guys, and watches you from afar, I guess my question is how does the government keep on sustaining paying their interest on their debt, and how is the QRA really gonna move forward, and how are they looking at all this stuff? Like, to me, the other night I couldn't fall asleep, so I was talking to my AI chatbot about the government debt, and instead of thinking it as 38 or 39 trillion, I cut it into 39,000. Then I was like, oh, so technically we have a person making $4,000 a year with $39,000 worth of debt, and it seems totally unsustainable. So I guess that's largely where my question comes from.
Right. So that brings in a lot of questions about debt sustainability and the difference between a government issuing debt and a person. A government that issues debt in currency it can't print, or backed by currency backed by physical asset like gold that it can't just create out of thin air, is more like you and me in our individual lives. We just can't issue that much debt. The government can issue as much as it wants, and all it asks from its citizens is, hey, you want spending and you don't want taxes? Fine. That means for every dollar we spend, that dollar is going to become one of you dudes' savings. And you're going to be forced to put that dollar into treasury bonds. And that's the mechanic. Always the case. The problem is the price. And again, it doesn't matter what interest we pay. We could pay 10% interest or 5% interest. As long as we can continue to issue debt, it will find its way back into savers' hands, and they'll be forced to buy treasuries with it. The problem is the price sets the price of a lot of other assets. And so what we have here over the last few years is a very large growing amount of debt that savers are forced to own. But because of the games that the Treasury and the Fed have played, most of that debt that has been issued has been in very short-term interest rate products, bills, two-year notes, and so on. And there's just an infinite capacity for savers to own cash-like riskless investments. Just an infinite capacity. They're happy to own it. Why not? It's earning 4%, for Christ's sake, and they have cash. They have cash because the government spent it. Became their earnings, and so they just they're happy to play that game. The problem is when you ask them to take on real price risk, and real price risk is duration. It's 10-year bonds, 30-year bonds, mortgage bonds, corporate bonds, all of these things that have price risk built into them that are different than two-year notes. And so we've written a lot about this here at Damp Spring. It's been sort of my go-to thing for many years. As long as the government continues to issue in excess of bill like very short-term paper, the debt sustainability question is, oh, by the way, short-term interest rates are also very strongly impacted by what the Fed does with short-term rates. So they really don't move very much. So as long as the Fed and the Treasury continue to focus on very short-term duration, it doesn't really create any sort of debt sustainability problem. It creates dollar weakness relative to goods and services, which is called inflation, relative to gold, etc. But it doesn't create interest rate risk. And it doesn't affect the economy and assets by causing the long-term interest rates to rise. And that's the world we've been in since QE. QT was muted by Treasury issuance. And so we come every month for every quarter since for as long as I can remember, I've commented on the quarterly refunding announcement. And that's coming on May 5th, the meeting's on May 5th, the announcement's on May 6th. And we'll see if this $2 trillion, $1.7 to $2 trillion deficit that we run each year, is going to continue to be funded with the same amount of new coupons every quarter that we've had for, I think it's been about 3 years now. It's been the same auction sizes. And that has suppressed long-term interest rates. Frankly, the Secretary of the Treasury, Yellen, manipulated the bond market with her issuance policy. And the current treasurer and one of the governors of the Fed, Bessent and Myron, heavily criticized them for doing that. And the new boss is the same as the old boss. Bessent has yet to do anything to extend the issuance, increase coupon auction sizes for the Fed. And so here we are. Will they do it this May? Clients will get on my note on that, but the odds are low. And so that means long-term interest rates are suppressed currently relative to economic conditions, meaning bonds aren't cheap. And there's this very large overhang for not only when the Treasury decides to issue more bonds, if the Fed decides to shrink its balance sheet, and then all of the other corporate issuance. Next week, we're going to get a ton of corporate issue. Well, as soon as the earnings season is over, the week after, we're going to get a ton of long-term corporate issuance to fund all of the AI that's being spent. I think it's the case that long-term bonds have a lot of headwind in terms of supply. And in terms of value, we've got 2s, 10s at 60 basis points and 10s, 30s at another 60 basis points. That's not much value in terms of going out the curve. So on the other hand, we just said, hey, SOFR's cheap, and so they're going to cut short-term interest rates. That will drag long-term yields down. The question is how much? And so here we are. I don't like bonds. Don't like them at all, for all of the reasons I just said. On the other hand, sort of like SOFR. So the question becomes, what do we do with bonds here? What do you guys think?
Well, first, there's like me in the QRA and Andy's like up here. Andy's the QRA expert, so I'll let him stick to the QRA stuff. But when we're talking about like just this idea that like that's too high or whatever, I mean, people have to put their money somewhere, right? You have to put your money somewhere, and like they can't put it in a bank account that's insured for $250,000, like they have to put it somewhere and that it's gonna be safe, right? Because they want it to stay, they want the value to be sustained. So there's always going to be a place for debt, and all the debt doomers, like obviously the bond prices will go up, but we're nowhere near that. The bond prices could go to 10% tomorrow and it would still be okay, like the world would survive. It would obviously be bad for people in markets, but the world would survive. Yeah, I don't want an orange duration. In fact, on the dip, I sold all my tips just to buy the dip. So like when it comes to the long bond, I think the steepener is going to come back into play, and it just got washed out to a degree that's insane. So, I like the front of the curve. I don't want to own the 30-year bond, 10-year bond. I don't want to own. I will take them for trades. I'll be in a trade for a bond all the time. But when it comes to like, do I want to own them? No, I want to own the SOFR. I want to be in the front of the curve. I think the Fed's going to cut rates. I think that it's going to be slow. I think they're going to cut a few times, and then you get your play, and then we'll see. I don't think it will drag the bond prices down that much. I think you'll have the steepener, and then we'll have a more normalized curve. Yeah, that's better for banks. It's better for everyone involved. So I think that's where we're headed.
I agree. I think that I think what we saw earlier this year was a crowded trade, a crowded steepener trade, a crowded they're going to run it hot trade, confident that he's going to come in here and stack the Fed and everything, and then those physicians got hit with Iran, and they got hit with Piro's indictment, and they got blown out. That was an overloaded boat, and they got fucking wrecked. I got wrecked in that a little bit myself personally. I was in the same boat. I didn't see Iran coming, but I think that's been corrected. I think those positions have been washed out. I think if you don't like bonds here, you ignore them, because I think SOFR is going to drag them up. So you just say, ignore them. I think we'll steepen again, and then there'll be trades, but bonds have some room to get dragged up, so just ignore them if you hate them, but there will be a time to lean into them, for sure. It's just not right now, I don't think.
So you think bonds we think stir's strong. It comes back to why are we fighting equities?
We're fighting equities right now just because we didn't really believe Trump's bullshit that like the war is over, and we kind of could see him, bullshitting his way through a very difficult situation that he got himself into with the closing of the straits.
I'm sure.
And there's no support below.
I'm short stocks because I don't think stocks can do well with oil price the way the futures curve is saying. Those other things, and I don't see any levers for them to pull to pump equities higher.
And Trump himself said, like, hey, I thought to tell you the truth, I thought crude would be higher at this point. I thought equities should be lower. He thinks mentally he has some room here, so this is far from over. This is very, one bump in the road, and we are back down to 6,600, and we're feasting on that shit.
So how about the hyperscalers? Because at the end of the day, big news this week.
Yeah.
The three major Tesla reported I guess they have a little bit of hyperscaling, but
the only chart that
the big three and Apple are reporting this week.
Yeah, I think the charts that don't really have much upside to me are probably like Amazon. I think they made a great run, but they're going to have some trouble. Microsoft and Meta are kind of in the same boat. They've come up to basically where they were last report, in which they have massive gaps above right where they are right now. So they could definitely, on a good report, go fill those gaps and then fail from there. And because that's what Meta did the last time. It went up to that, it filled its gap at 750 or whatever, and then it was by sell the news from there. So we could see a replay of that. There's not the only compelling technical setup I see. Well, Microsoft is a compelling technical setup because it's got it's got $50 of room above in that gap if it beats, but Google has been behaving like technically sound, and if they crush it, they could really they have some room, they could move, but the overall, the indexes and the bigger picture stuff, I wouldn't touch any of this stuff. This all screams we make highs this week on terrific earnings, and then turn around. Nothing from this weekend, by the way. We went into Friday that we were going to have peace talks, and now the peace talks are off. That's not positive. I'm sure we'll get some more.
Most positive thing about the weekend is we're not down 8%, 100 basis points in leading into the open.
Right, the liquid markets.
Yeah.
Right. Yeah, but think of
every
like
week that it's been the same thing.
Think
Down
of vol
100
though.
basis points and open week, and it's buy straight from there.
Vol's been sticky though. It won't give up that 20 area, the VIX curve. It's vol and crude will refuse to wash out on this bullshit. And I don't think you can buy equities until you see vol and crude accept, the big picture. I think equities are getting squeezed, and vol and crude are the skeptical people in the corner, and I think you have to keep your eye on them. They're telling you to fuck this, don't join this crew,
I guess like this, when it comes to equities, like obviously, like I just don't think that like you should trade the equities based on the oil. I don't think you should trade. I think they made their move, and like you said, like I raised some cash and stuff, but the reason there's one of the things, like I would much prefer to play the dollar. I'd much prefer to play gold. I'd much prefer to play the bonds. I much prefer for SOFR than to touch the equities. And that's just how I trade, just because I don't like being short equities, just because this is the type of things that can happen when the breath blows out, And so that's why I buy dips, but you're never going to come on here and be up a bunch on some puts because of me, because I don't buy equity puts. It's never going to happen. Right?
We know this. We know this.
And when I said, by the way,
my point.
I don't mean to be judgmental. It's just a fact. You're more biased to be long equities than I am. I can't speak for Jimmy. By the way, when I'm not talking about alpha, I'm always biased to be long equities. Equities are great.
No, I was saying that as the thing is that, like, now I don't think that if we have an Iran thing, that's like say Iran's over tomorrow, I don't think that's a reason to buy equities. Say that they cut rates, I don't think that's the time to buy equities. The time to buy equities was when they were low. Now's the time to raise cash. I don't want to be short, just because, like I said, I've looked at the data, I've seen how crazy things can be, and I've lived through it myself. And so I just step back and say, fuck it, let them go. like let it go. And then eventually it'll crash, I'll buy it again. But all I'm saying is, you have someone who doesn't short equities, that's me. And I don't think if good news comes, that's the time to buy. I think that's the time to step back. I think that's the time to look at your cash. And then I think it's the time to say, hey, like, where's the opportunity? And I think there are stocks to buy, individual names in stocks. But and then as far as the hyperscalers go, we're continuing to go into this tech thing where things are better than we expected. So example, Intel went up because people have largely forgot about processors. It's all graphics cards. And then you have Google with the TPU, the special cut. You know what I mean? Like, there's new technology that's coming out, and now we're noticing that they're rotating back into the old technologies. Like, processors haven't been a thing since Bitcoin took off. It went all straight graphics cards. The graphics card is now considered the brain of the computer, not the processor. It wasn't always like that. And so now we're starting to see that it's all important. And so as that goes, as we start to see these companies, you're going to have that euphoria into these stocks just because it's new. It's like, oh shit, they made a bunch of money because people need processors. We forgot about processors.
And storage.
Yeah, like you said, like, oh, we need DRAM and we don't have enough of it, or we need this. And that can happen for a long time. And people are people. They're going to chase. They're going to do things like that. So it's just, are the hyperscalers probably, when we're talking 10 years from now, are they, oh, who knows? Who knows? But, like, that euphoria cycle I don't think is over. And so, like, I think you have to keep that in the back of your head. And as you can see, it is showing up in the data. And at some point, it won't show up in the data. At some point, it won't be creating these things. Like, NVIDIA is decently priced right now, but it's not gonna, like, that's gonna adjust. You know what I mean? Like, and Intel had the biggest gap up in its, like, valuation ever, but that's gonna even out too. So it's, you know, these things are gonna even out, and I think the most important thing is just, you don't have to know all this stuff today. Like, there will be signs, there will be data, and then you can kind of follow it that way.
Wise points.
All right. Sounds like we've come to the end of this episode, so we'll be back next month with the 5th roundtable. Thanks for watching.